Monday, May 6, 2024, Monaco 64, home of alternative economics and contrarian views. Some of you have worries about gold confiscation, so we're going to look at that today. We're going to look at the recent proposals by the Biden administration for capital gains taxes on unrealized gains, which sounds crazy, but it's something that's being talked about. And we're going to look at the Great Taking again. I covered this last year in September. I have a video, my first video on it did really well, so you might want to watch it. Yes, you can read the Great Taking online. There's a free PDF, but you can also buy the real book. And before I start, I'd like to thank all of you again. We went over 100,000 subscribers yesterday, and the reason why I say we and not I is because it's not just me doing it, it's you as well. As Graham Hobbs, a longtime subscriber, always said to me, Monaco 64 is not just you, it's a community. So thank you again. The other thing I wanted to say is about fear. I see some comments out there in my videos that I'm promoting fear, that I'm a doom monger or something like that. But all I would say is that, yeah, things are never always rosy, and things are never always really bad and dark. That's how life is. It goes in ups and downs. And what I try to do here on this channel is to try to tell people to the best of my ability how I think the current monetary system is really in bad shape and has been since 1971 really, but it's really gotten worse since around 2008 and even before that, I would say. And that gold and silver are a good way to protect your savings. If that sounds fearful, so be it. I mean, if you look at gold's performance since the year 2000, it's averaged about just over 9% per annum in all the major fiat currencies. Where I am in the UK, it's averaged just over 10%. So, yeah, all I'm trying to do here is what they want to do or tell you in the mainstream press, in the mainstream investment advice space, is to warn you that there is such a thing as a currency. I know it sounds weird, but the currency is the common denominator of value. So if some of your assets go up in nominal terms, it looks really good. But if the currency is going down more than that, it's not good. It means you're losing out. And that's what I try to do here. So back to, let's start with gold confiscation. And the last major confiscation, of course, was in 1933. Executive Order 6102, and FDR used Trading with the Enemy Act from 1917 to be able to do this legally. And up until then, gold was money in the US, and almost everyone probably had a bit of gold. So yes, it affected a lot of people, even though the minimum that you could hold per person before they confiscated was $100, which was just under 5 troy ounces. So if you had 4 or 5 troy ounces and your wife had some as well, you could have kept that. So it wasn't all gloom and doom. And I think a lot of the elite, they knew this was coming. There are stories about how, the higher ups, the billionaires of the time, the DuPonts and Rockefellers, they got their gold out of the U.S. 6 months or a year before and put it in Switzerland. So there are always ways out of this. And some people have done some research, I think silver doctors, to the effect that they only really got 25% of all the gold. The rest probably left the country or, was hidden, probably on people dug their gold and hid their gold with the version of their dirty man safe back then. And again, if you're interested in keeping your gold safe, check out Dirty Man Safe. There's a link below in the description if you're interested. You get a 10% discount and a gift if you use my link. But back to gold confiscation. So what I'm trying to say here is that back then, people knew gold. Gold was synonymous with money. Yes, they used to carry Federal Reserve notes or Treasury notes that were redeemable in gold. So gold was money, the rest was currency or promissory notes. But nowadays, some of you might have seen the videos with Mark Dice where he goes around giving people the choice of taking a 1 ounce gold coin or a Snickers bar. And most people don't want the gold coin. They'll say, oh, I have the Snickers bar. People are ignorant. They probably won't even recognize a gold coin. So what I'm trying to say here, and again, in this world, of course, anything is possible, and they could come after your physical gold, but I think the likelihood is very small. I've spoken with Clive Thompson about this, and he thinks that the way they could do it is through ETFs like GLD, which supposedly hold a lot of gold to back those ETFs. They could come after that. And that's why I'm going to jump to this story from Reuters here that came out at the end of April. It says, regulators told to be ready to handle failed clearing houses. And that's got all to do with the great taking. And I recommend you watch my video from September last year. Recommend you read the book. David Rogers Webb, he's done a lot of research, and he says that in the next great taking, or because 1933 was a great taking, they took your great grandparents and your grandparents' gold. In the next great taking, they're going to take your investment assets to use as collateral. Of course, it's not certain. And nothing is certain, but it's a possibility, as David Rogers Webb says. So that's why I think they won't care about your coins that you put somewhere. It's too cumbersome and hard to get. So I actually think gold confiscation is highly unlikely. But let's read through this article from Reuters. I think it's important, because they wouldn't be talking about this if there wasn't any problem in the system. And again, when you are investing in the stock market, and I have some miners, gold and silver miners, you have to assess what kind of risk you want to take. And they might not come after the miners or some kind of assets. They might go after ETFs, which are basically derivatives. Really, ETFs. They might go after treasuries. They might confiscate China's treasuries and use that as collateral to save the clearinghouses. And the clearinghouses really shouldn't be in trouble, because they're just there to settle trades amongst counterparties. But our system is so screwed up that they've put the clearinghouses in this position, and mainly because everything is highly leveraged. And there's also the practice of not when people short securities, they're not really borrowing it. They're shorting things that don't exist. It's a mess. So this is what it says. Regulators must equip themselves with tools such as bail-in bonds to deal quickly with a failed clearinghouse for stocks, bonds, or derivatives without having to call on taxpayers for cash, the G20's risk watchdog said on Thursday. After the global financial crisis of 07-09, regulators mandated clearing for a wider range of derivatives, meaning they must pass through a clearer backed by a default fund to ensure completion of trades. More recently, the U.S. has adopted rules to force more trades in the $26 trillion and increasing U.S. Treasury market through clearers. As a result of such changes, some clearers have become vital to financial systems in more than one jurisdiction, meaning their failure could damage financial stability unless they can be stabilized or resolved, meaning closed down in an orderly way. The Financial Stability Board, FSB, well, that's the Bank for International Settlement. It's a bank that is supranational, that's owned by the central banks and banks like JP Morgan and Citibank, and is totally above the law. They're making the rules, right? Said its new standard, which builds on previous guidance, requires that adequate liquidity, loss-absorbing, and recapitalization resources and tools are available to maintain the continuity of a clearer's critical functions and mitigate adverse effects on financial stability should a shutdown become necessary. It sets out 7 resources and tools that regulators are required to pick from, such as bail-in bonds. So bail-in bonds would be issued by clearers that can be written down to plug losses, resolution funds, cash calls during resolution. Well, cash calls would mean that the counterparties that trade through that clearinghouses, they would have to put more margin up. That's all it means. And equity in a first loss position resolution. Regulators will have to state publicly which tools they have selected. Laws could be needed, changing or introducing in some countries to give regulators access to such tools. I think according to David Rogers Webb, these laws have already been implemented. They're just saying this to prepare you for it. Temporary public funding for liquidity should be relied on only as a last resort, said the BIS or FSB. So yeah, what does that mean? Well, the taxpayer will bail them out because that's what public funds are, and I'm sure they'll find a last a situation where there will be, they will resort to a last resort. Exchanges such as LSE, ICE, CME, and Deutsche Börse all operate major clearinghouses that handle trades totaling trillions of dollars. The G20 economies commit to apply regulatory recommendations from FSB. And the watchdog said it would monitor implementation and publish its findings. So yeah, that is a little bit worrying. I'm not saying this is going to happen, but they're looking at it. So now let's switch over to this proposal by the Biden administration. Forbes has covered it. April 30th story. It says Americans overwhelmingly reject Biden's plan to tax unsold assets. Yes. You might have bought, let's say, $25,000 in gold, and gold doubles and it becomes worth $50,000. But you won't be, unless you are worth more than $100 million, you won't be liable to this, according to the, the proposal. It says here, in case you missed it, a $5 trillion tax hike looms over American households and businesses in President Joe Biden's latest budget proposal, which would include a 25% annual minimum tax on unrealized capital gains for individuals with incomes and assets exceeding $100 million. I'm not saying this is a good proposal, but unless you're worth or you have an income more than $100 million, you don't have to worry about it. And I think for people, even people who are worth that much or more, I don't think this will go through, but let's just quickly go through what this means. So Forbes continues, if signed into law, this would increase the top marginal rate on long-term gains and dividends to a jaw-dropping 44.6%, marking the highest such rate in U.S. history. So why are they doing that? Why do they proposing such heavy taxation? Well, it's happening here in the UK, mainly because Uncle Sam is up to here in debt. The debt is going to keep increasing astronomically, and he needs to service that debt. So he needs more taxation. That's what it's all about. Biden's plan proposes other changes to the tax code, but I want to focus on the part involving unrealized gains, since it could have a sweeping unintended consequence for the U.S. economy, personal liberty, and the very fabric of American innovation. To be clear, I don't believe a deeply divided Congress would be able to find the votes necessary to approve this policy, but it's crucial that people are at least aware of the potential ramifications. When gains aren't gains, so let's go through this. I'm not going to go through the whole article. I'm going to put a link to it in the description. You can read the whole thing. The idea of taxing unrealized capital gains increases in the value of an asset like property or stocks that haven't been sold yet is not only unprecedented, but fundamentally flawed. Imagine purchasing shares in a company for $1 million, and next year those shares appreciate to $1.5 million. Under Biden's plan, you would owe tax on this $500,000 gain, despite not having sold the shares or realized any actual profit. Now imagine that the stock's value drops back to $1 million the following year. You already have paid the 25% on a gain that existed only on paper, and now you're also left shouldering a financial burden without any actual economic benefit. So you can see how flawed this is. That's where we stand in terms of gold confiscation, the great taking, these capital gains taxes. Yes, it makes people scared, and I understand, but it doesn't mean it's going to happen. And there are always ways to protect yourself, and one of the ways to protect yourself, of course, is having some physical gold and silver outside this financial system and keeping it very safe, very well hidden, because they won't have the wherewithal to look for that. But by keeping a lot of stuff in the financial system, it's very easy for them to come and get it, even though it's not really certain. I'm not saying they're going to come and get it. So that's what I have to say about that. So let's quickly look at where the markets are then this morning. It's 8:20 a.m. London time. So we've got spot gold, 23.13. It's up about $12. The low has been 22.91 and the high has been 23.15. Silver actually is doing quite well this morning. It's up almost 2%. It's trading at 27.06. It's up 51 cents. The high has been 09 and the low has been 26.41. One thing I noticed last week, silver tested that 26 level a few times, and if you remember well, like over a month ago, I was talking about how that 26 level was really important. If we broke out of that level, we could quickly go up to 30, and we almost did. So I think what we're seeing in silver or have seen in the last week was a retest of that breakout, and it's encouraging that it's bounced back. Anyway, Dow futures up for 48, the NASDAQ 100 futures up 20, S&P is up 8, so stock market fairly steady. The currencies as well are fairly steady. Not much to write home about. What about the dollar versus the yen? Well, the dollar is up 0.5% at 153.75. It's way off from the 160 level we saw last week. We're going to keep an eye on the dollar yen because it's important for the health of the whole financial international system. Commodities, WTI crude is up 0.75%, 78.50. Brent as well is up 0.75 at 83.40. High grade copper is up 1% at 4.60. And yet treasury yields have come off a bit ever since the Powell announcement that they're gonna cut back on QT. They're gonna taper it quite aggressively from June, and also the weak jobs data we had on Friday. So right now the 10-year yield is below 450 at 448. We were approaching 4.75 early last week. So with that, I'm going to wish you all a very good day and a very good start to the week. Take care. Bye.